Hey everybody, Jeff Bangeter here. I want to talk to you about the new reverse mortgage products that are available. So I'm going to go through the detail with the illustration here. I'm using a client that was born in 1939, and that is one of the factors in getting a reverse mortgage is your age, the interest rates, and your home value. So let's go through this. The first one I'm going to go through is the HECM 60 LIBOR. The LIBOR stands for London Interbank Offered Rate. This is an adjustable rate mortgage. So the interest rate does change. It's driven by a margin and the LIBOR rate. So in this case, the margin is 2.75, giving you an initial interest rate of 2.907. The expected interest rate is an interest rate driven off of the 10-year rate, and this is the actual interest rate they use to calculate how much money you can get. So this would be the rate they're charging. This is a calculation on how much you can get. There's ongoing mortgage insurance. This is on all of them. This is a FHA fee of 1.25% of the outstanding balance of the loan every year. This is to ensure that if the lender goes out of business, you're still going to get paid. It also ensures that if you live a really long time and the debt on the house is more than the value of the house, that the lender will not lose money on the transaction. On the variable rate, they do have a cap on the interest rate of 10 points above the start rate. So the start rate's 2.907. 10 points above that would be 12.907. This can strip equity away out of your house faster. However, it's a good thing if you're using a line of credit. If you leave the money in there, then they're giving your whatever's equity is left in the home that's available, they give it this line of credit growth rate. And the higher the interest, the faster it grows. So it could be of benefit to you depending on how you take the money. So we're going to go to the home value. I'm going to use $400,000. The maximum home value that they'll use for the FHA reverse mortgage is $625,500. In this case, we're below that, so the maximum claim amount happens to be the same, the $400,000. If your home was worth $700,000, then you would see a home value of $700,000 and a max claim here of $625,500. Principal limit is the first part of that calculation. They took the client's age and the house value and the interest rate, and they came up with this principal limit of $212,400. Then there's an initial mortgage insurance premium. This is what you pay the federal government to get a reverse mortgage, $2,000 in this example. An origination fee, this is how I get paid and my processors and the company to put the whole loan together for you. Other costs would be title insurance, recording fees, all the things that would be in a normal real estate transaction. And then any credits would be illustrated here. Your remaining principal limit is just taking the $212,400 minus all those fees, gives you $202,381 in this first loan. Any liens, if you have a mortgage, we have to pay it off. So if you had a $50,000 mortgage, it would show up here and we would have to pay that off before you would get any money. Okay? Repair set aside, if you have some damage on your home that it does not qualify under FHA standards, then we would have to set money aside to repair that. If you want us to set money aside for taxes and insurance, we can do that as well. That's pretty uncommon, but it is something that we can do for you. So total mandatory obligations, this is some new terminology in the reverse mortgage world. This is the total of all of these fees and any mortgage and repair set-asides and taxes and insurance set-aside. All of those, now in this case it's just the startup fees that I'm showing, so $10,018. And that is 4.72% of your principal limit. So that kind of gives you an idea of the origination cost for everything, including the FHA insurance, is about 4.72 in this example. The initial distribution limit, so $127,000 is this initial disbursement limit, which is 60% of your remaining principal limit. That takes us, they reuse this again, showing us again the net principal limit, and then they say, okay, well the maximum that's actually available to you is $117,421. And then you could take that and then leave $84,960 in a line of credit. Now, if you would prefer, instead of taking all of this money, you can get $1,403 a month every month for the rest of your life. So that's called a 10-year payment, not 10 years, but 10-year lifetime payment. 1,403. I have a lot of clients that prefer that. It's nice, steady, guaranteed monthly income. Guaranteed for life by the federal government. It's a good deal. So your initial loan balance, 127,000. That's again assuming that you took all of this 117 plus paid the fees here. All right, let's go up to the HECM 60 fix. This is a fixed rate loan. This is the federal government's program. 5.06 is the current rate. The origination, the ongoing mortgage insurance rate is the same, 1.25. That's the same for all of them. And then the cap on the interest rate is the same as the 5.06. You don't have to worry about it changing. There is no line of credit here, so it's not going to grow at anything. Home value 400. So the max claim again is 400. Principal limit 235. Now it's a little more because of the interest rate here, 5.06 versus 5.6. So there's a little bit more money available, 235.6. Same initial mortgage insurance premium, origination fees, and other costs. So 225,581 is the remaining principal limit. Again, we'd have to pay off your loan or set money aside if that were the case. Total mandatory obligations, again, the same, 10,118. That's 4.26% of the 225,000. So that shows you the cost of getting the loan. The initial disbursement, 141,360. But again, they put this 60% limit on that, so you're not going to get all of that 141,000. The net principal limit, 225,000. So here's how it really shakes out. The government's going to allow you to take $131,341, and that leaves an unavailable principal limit, the money they didn't let you take out of this 225, 94,000. The good old days, you could have got that 225,000, and that would have been the check you got. But now it's 131. You're going to leave this 94,000 out. You can't touch it. It's gone forever. So that's the new program the government did. They wanted to make sure you didn't go upside down, or I don't know. I'm not really sure what their logic was. I don't think it was a good idea. Anyway, let's move on. So these are the two new ones, the HECM Choice 506. This is really an interesting new loan. This is brand new. So the interest rates are the same, 5.06. The FHA insurance is the same, fixed rate, of course, 400,000 still, 235.6. Again, it's the principal limit. All the fees are the same. They're showing a little bit higher here. That's, again, $500 difference. Not going to make a big deal on getting the loan. $225,000 again is the remaining principal limit. We'd have to pay off any mortgage, of course, that you might have. So $10,000 in charges to get the loan. That's 4.48% of the remaining principal limit. $141,360 again is the initial mortgage, the initial disbursement limit, but then they use their 60% rules on the $225,000 and say you can only get $130,000. So $130,000, little tiny bit less than this because we had a couple $100 more in fees. But what's really interesting is you can get the $130,000 and we'll give you $621 a month for the rest of your life in a monthly 10-year payment. So this is kind of what we did, is this $94,000 that otherwise went away and just was unavailable. We've converted that to a payment for the rest of your life. I think that's a great option. So now you got $130,000 up front and $621 a month for the rest of your life. Great opportunity here. And then the last one, this is also brand new, the Fixed Advantage. Same fixed rates, same FHA insurance, 400,000 home values, all this is the same. Get the 225 remaining principal limit, the 10,000 in all the fees to get it set up, which is 4.26% of the principal limit. 141,000 again is the initial disbursement limit. They use 60% of this 225 gives you, so they can give you 131, so about the same as these others. But now the second year, you have a line of credit with 94,000 in it. The same 94,000 that was unavailable, right, is now available in the second year. So 131,000 the first year. Second year, you could come up and say, I want the other 94,000, or leave it in there and just access it when you want to. That's an option. So now we've taken that 94,000 that was unavailable through the private lenders. They've made it available for you. So these two new loans, this Heckham Choice 506 and the Fixed Advantage, I think are great opportunities. Even the regular reverse mortgages, we just see them really help a lot of people, absolutely change lives. So if you're ready to get a reverse mortgage, give me a call. My toll-free number is 800-451-2351. If you know somebody that needs a reverse mortgage, whether it be a client or a friend, whatever the situation is, definitely give me a call. I do these in California, but I know people all around the country. So regardless of where you're at, call my toll-free at 800-451-2351. Thanks so much for listening and watching today.